Answer to the first question is yes. I think we'll see more of the same. I think even with oil prices stabilizing at slightly higher prices than for parts of 2016, governments have a lot to do, both in terms of fiscal gap and intention and aspiration to invest more. Answer to your second question, as mentioned on the panel that I was moderating yesterday morning, I think that GCC has expanded its access to liquidity, and therefore even if there should be more sovereign supply, I don't anticipate any issues with corporates or SOEs getting the liquidity they need. I think liability management exercises tend to be from entities that have debt coming due that they want to extend, but they don't necessarily want to raise new debt. Therefore, that may continue to apply to some issuers, but actually, to the extent I believe that financing requirements are still going to remain high, I think the majority of activity will be to raising, with regard to raising new money, and liability management will be at the margin of that, not the main event, so to speak. I think sectorally, I don't know whether you count sovereigns as a sector, but clearly, if we're talking about this year, 2017, the large sovereign transactions continue to be the most eye-catching. I think on the SOE side, the supply continues to be relatively constrained, and I think most investors, if they're hungry for any of the main segments, not sectors, I would say, they would prefer to see more corporates and SOEs. Banks have attracted slightly more indifference, partly related to regional liquidity, but also related to implementation of Basel III in the region. I wouldn't go into particular names because I don't think we're quite there yet in terms of visibility, but I do believe that the SOEs will follow the sovereign. Some have issued in the past and some haven't. I think that the banks may come with a slight delay to that because they still perceive themselves as very, very liquid, and therefore while the liquidity cushion may be reducing over time, they seem to be still with what they consider excess liquidity at a point in time. Yeah, I think the answer to the first question about levels of supply, I think there's no secret. It's really oil prices driving that. Although I do feel that even if oil prices should rise a little bit from the 50 area, that rather than cut back the supply of financing, mainly the sovereign issuers and potentially SOEs as well will take advantage to take a similar amount of financing, but get a bit further ahead with the investment program or progress that faster than they might otherwise have done. So that's on the supply side. Spread-wise, I think the region has, in my view, remained very well supported, and to the extent we do see the interest rate cycle or credit cycle turning somewhat, potentially relatively slowly, I think there's a higher probability of spreads drifting slightly upwards rather than downwards, but it's still quite finely balanced. I don't think we have any signs of a major turning point right now.